Segment reporting. Why segment reporting? What is all of this? Segment reporting helps to provide information by breaking out a company's activity in various financial or economic components. Segments may be broken out in a variety of ways. These could include by product, service line, geography, etc. Great examples of geography is Apple US versus Apple Europe, or by product or service line. So Microsoft Gaming, so that's Xbox and everything, and then Microsoft Office. So that's all of their, Office components and Excel and everything like that. Maybe I care more about the gaming, or maybe I care more about Apple Europe. This is helpful because also for investors, maybe one of their segments is starting to lose money. We want to understand the entity's performance better, right? We want to assess each segment's prospect for future net cash flow. And with these, we can make more informed judgments about the entity as a whole. So an entity is required to disclose segment profit and loss, segment assets, related items, but not required to report segment cash flow. Operating segments. So operating segments are defined by a few characteristics. Operating segments engage in business activities with the purpose of earning revenues and incurring expenses. These may also include internal operating segments, which buy and sell from other segments. So operating segments have their operating performance reviewed by a chief decision maker within the organization, who may allocate resources toward or away from the segment. And they also have discrete financial information available. Just a little bit more about operating segments, right? Think of McDonald's US, or maybe McDonald's in each state breaks out in operating segments. I'm not sure how they're actually structured. That could be an instance there. Not operating segments. So remember, we said operating segments over here. We said that operating segments have business activities, they earn revenue and incur expenses. Well, a company's corporate headquarters or a pension plan, these are not operating segments. So while a company may have legal entities set up for a core segment of business, unless these segments exist for the firm's main activities of operating for a profit, they are not considered operating segments. So maybe a whole legal entity exists for the corporate headquarters. So while corporate headquarters usually employ the salaried administrative employees and may generate some incidental profit, these would not be included because this is not what the company does. They do not operate to have a corporate headquarters. They operate to make money some other way. Pension plans. They don't operate to have a pension plan. They operate to make money, and they just happen to have a pension plan. So a post-retirement plan will usually be its own entity, its own legal entity. However, it does not fall under the category of existing for business operations. Now, is each segment separately reportable? We've got two tests, 10% size test and the 75% reporting sufficiency test. We're diving into each of these, right? So let's talk about our 10% size test first. Well, basically, if a segment makes up 10% or more of these items we'll see here, it should be separately reported as a segment. So revenue, reported profit or loss, or assets. I'm really going to just summarize this up. If, let's say, we're dealing with AMD, the microchip manufacturer. So AMD, they make microchips. Maybe overall they make $10 million. Obviously they make more than that, but for my example, they make $10 million. Now maybe AMD, maybe their Japanese segment. So in Japan, this is revenues. Maybe in Japan, they make $1,200,000. Well, this is more than 10%. 10% of this is 1 million. So this is more than 10%. So Japan would be its own segment and broken out and reported separately. But if Japan, let's say, only made $800,000, this is less than 10% of their overall revenues. So it would not be stated separately as a segment. It would be under the umbrella of AMD. Now, you do that for revenue, you do that for profit or loss, and you do that for assets, right? So if there's 10 million of assets, same thing, same deal there. The only really difference here, so revenue and assets are treated the same way, like kind of just I described to you. However, for reported profit and loss, we list out all segments and some of their total absolute amount of profit and loss. So remember absolute value. When was the last time we saw absolute value? Maybe in school or something. So this is, you just make everything positive, right? Everything's positive, and you sum it up all together because you just want to see their overall activity. And there'll be a bunch of questions with this. Practice these types of questions. They're super important, super helpful, and you'll do well with those. Last up here, this is the 75% reporting sufficiency test. If the total consolidated revenue reported by operating segments constitutes less than 75% of external consolidated revenue, additional segments need to be identified as reportable even if they don't meet the 10% tests until at least 75% of external revenue is included in reportable segments. What this is saying is we want to break it out enough that investors are seeing the different segments, but as this says here, there's a limit. We don't want to break it down to a million segments because that financial statement users would get overwhelmed. So the maximum amount of segments is 10, but we want to make sure that within those segments, that the revenue from those operating segments does not equal less than 75%. So we want all of these segments broken out, right? We want them all broken out. We want them to accurately reflect how the company's doing by product line, by geography, like we talked about before.